Imagine being wrong at your job, like 70% of the time.
That sounds like a quick way to get fired, honestly.
Right. I mean, failing day after day, constantly missing the mark, and yet at the end of the year, you are wildly profitable, like making
It
millions.
completely defies logic.
It really does.
Yeah.
Because we are so conditioned to believe that success, especially in something as, chaotic as the stock market, requires this sort of crystal ball.
Yeah, perfect predictions.
Exactly. Like you can never make a single mistake. But today's deep dive is going to shatter that completely.
Because, I mean, we're conditioned to chase this illusion of perfect precision, right? We just assume the people taking money out of the market are simply predicting the future better than you are.
And the mission for our deep dive today is to totally dismantle that assumption.
Let's do it.
So we are exploring this highly detailed trading strategy document we've got in front of us, alongside a stack of 14 historical stock charts spanning from early 2021 all the way into 2025.
And it's all focused on just one specific asset.
Right. The entire data set is laser focused on one single stock. It's SCE, which stands for Fertilizers and Chemical Travancore. And the core paradox we are looking at today, the real secret to profitable trading according to these sources, it isn't about predicting the market perfectly at all.
Not even close.
It's actually built on a philosophy they explicitly call trading for loss. Okay, let's unpack this.
Yeah, so trading for loss sounds like a total typo at first glance.
It sounds insane, yeah.
But the math behind it is actually airtight. However, before we can even talk about the mechanics of making money, or, intentionally losing it, we have to establish the ground rules of the arena.
Okay, what do you mean?
Well, if you're staring at a screen trying to make a trade, you have to understand who actually moves the price of a stock.
Let me guess, it is not you and me sitting at our laptops in our pajamas, like clicking the buy button on 100 shares.
Far from it. But the foundational concept from this strategy document is a term called imbalance.
Imbalance.
Right. An imbalance in the market is created exclusively by massive institutional buyers.
We're talking the big guys.
Exactly. Major banks, massive hedge funds, multi-billion-dollar algorithmic trading desks, retail traders, which is everyday people managing their own savings. They simply do not possess the capital required to create this kind of supply and demand imbalance.
We're just too small.
We cannot move the market. Our only option is to look for the footprint left behind by the institutions.
I keep thinking about this like ocean surfing.
Oh, that's a good way to look at it.
Yeah, because if you are a retail trader, you are basically splashing around in the shallows on a little boogie board.
Right. You aren't creating the waves.
Exactly. The institutions are the ones out there displacing millions of gallons of water, creating these massive tectonic tidal waves. And the sources actually map out exactly how big those footprints have gotten over the years, which is wild.
The timeline of volume requirements noted in the data is absolutely mind-blowing.
It really is. Like, let's look at the actual numbers they recorded for this specific stock, FAC. Back in 2018 and 2019, seeing a trading volume of 50 lakh, which translates to 5 million shares, that was enough to prove an institution was buying.
But watch how aggressively that baseline scales up in the document.
Yeah, walk us through it.
So it shows that by 2020 and 2021, the requirement to confirm an institutional footprint jumped to 1 crore.
So 10 million shares.
Right. And then by 2022, you needed to 2 crore.
Wow.
In 2023, it was 3 crore. 2024, 4 crore. And now, tracking into 2025, the document states you need to see a staggering 5 to 10 crore.
Wait, 5 to 10 crore. That is 50 to 100 million shares traded in a single session.
Just to register that institutional footprint, yeah.
Seeing this massive inflation in the volume requirements over just a few years, it really makes me wonder about that ocean analogy.
How so?
Does this mean the ocean is just getting significantly more crowded with big players compared to a few years ago? Like, why the sudden need for a 10 crore volume day when 50 lakh used to be the gold standard?
That's a great question. The market mechanics are undergoing a fundamental shift. Liquidity pools are just much deeper now.
Oh, okay.
And institutions are deploying significantly larger blocks of capital. A lot of this is driven by the rise of automated and algorithmic trading.
The machines take over.
Basically, because the baseline level of daily trading activity is so much higher now, you need a proportionally larger wave to prove it's actually an institution initiating a major position.
Instead of just, what? Like random noise.
Exactly. Instead of just a localized ripple of retail algorithms trading back and forth, what's fascinating here is you have to know how you actually spot these big players amidst all that daily market noise.
Right, because you don't just look at a spreadsheet of volume numbers.
No. You look for a highly specific visual signature on the chart. You need to see a massive volume spike paired immediately with a strong initial price candle.
So big volume, big price movement.
That combination, exceptional volume plus an aggressive sustained move in price, is the literal, undeniable footprint of institutional money entering the arena.
Okay, so mathematically that makes sense. We've spotted the massive wave, the institutions are in, but how do you actually ride that wave without completely wiping out?
That is the million-dollar question.
And this brings us to the psychology of the strategy, which contains that incredibly counterintuitive quote we teased earlier.
Trading for loss is the secret of profit.
I mean, how is losing the secret to winning? It goes against every instinct a human being has when money is on the line.
It really does. But it comes down to detaching entirely from the ego of needing to be right.
Which is hard to do.
Extremely hard. But the document is incredibly firm on this principle. It says, win rate is a myth, risk-reward is reality.
Win rate is a myth.
Yes, the entire strategy is anchored to a strict, non-negotiable risk-reward ratio, or RR of 1 to 4.
Okay, let me break down the actual math on that for you listening because the sources lay it out perfectly and it completely flips the script on how we think about risk.
Go for it.
So imagine you have a trading account. The rule is you only risk 1% of your total capital on any single trade.
Right, just 1%.
If you are wrong, you lose exactly 1%. But if you are right, because of that 1 to 4 ratio, you make 4%.
Yep, the math is simple but powerful.
The text points out that if you take 10 trades and you have 2 wins and 8 losses, you simply break even.
Think about that.
You lost 8%, but your 2 wins made you 8%. 0 loss, 0 profit.
And taking that further, if you win just 3 out of 10 times, you are officially profitable.
The 30% win rate.
Yes, you only need a 30% success rate to grow your account. You lost 7%, you made 12%, you were up 5%.
Hold on, though, because if I only win 3 out of 10 trades, my immediate human instinct is to abandon my strategy.
Because it feels terrible.
Exactly. I feel like a total failure. Losing 70% of the time sounds psychologically devastating. How does a normal human being actually stomach being wrong that often without panicking, ditching the rules, and, revenge trading their account to 0?
You've just identified the exact psychological hurdle where most retail traders fail.
The panic.
Yeah, the human brain interprets a string of losses as a literal threat, which triggers that panic response.
So how does the document address that?
It answers this by establishing what it calls the golden rule of trading.
Okay.
The rule is entirely mechanical. You give a small, fixed risk to the market, specifically 0.5% to 1% of your capital, and you only take big returns at that 1 to 4 ratio.
So you cap the downside, always.
Always. The foundational logic is that you cannot physically be right every time, but you also cannot be wrong every time. You just need to preserve your capital long enough for the mathematical probability to play out.
I see. Because if you strictly adhere to the 1 to 4 ratio, one single win literally erases 4 consecutive losses. It pays for your mistakes.
It absolutely does. And the document actually cites a brilliant historical example to drive this point home.
Oh, right. Richard Dennis.
Yes, Richard Dennis. He was a legendary commodity trader who essentially ran an experiment with a group of novice traders called the Turtles.
The turtle traders, yeah.
Dennis made millions of dollars, and the astonishing part is his accuracy rate was only about 5%.
Wait, 5%?
He was technically wrong 95% of the time.
That is absurd.
But his risk management was so incredibly tight, and his winning trades were allowed to run for such massive gains that the win rate simply became irrelevant.
Wow. Okay, so we have the high-level philosophy. We know we're hunting for institutional tidal waves, and we know we're doing it with an ironclad 1 to 4 risk-reward ratio, fully prepared to lose the majority of our trades.
Exactly.
But that requires actually catching the wave. When you're staring at a live chart, how do you mathematically prove a wave is forming without just guessing? Let's move to the actual mechanics on the screen. How does this play out on a random Tuesday afternoon?
Let's outline the technical setup as defined in the source. The primary time frame for this intraday strategy is 15 minutes.
So every candle on the screen represents 15 minutes of trading.
Right. And the trader is looking at 3 specific indicators overlaid on the price: the 10, 20, and 50 EMAs, or exponential moving averages.
I want to make sure we define that clearly. An EMA isn't just a simple average of past prices, right? It's a mathematical line that gives much more weight to the most recent price action.
Exactly. It hugs the current trend much closer.
But there is a massive disclaimer in the text about these EMAs that we absolutely cannot skip over.
This is a critical distinction to make. The document explicitly states this is absolutely not an indicator-based strategy.
Say that again because people love their
I
indicators.
know, but you aren't blindly buying just because two moving average lines happen to cross on a screen. That is how retail traders lose their money.
Right.
The EMAs are only there to identify the underlying trend condition.
Right.
Specifically, you want the 10 EMA, the fastest moving line, to be above the 20 EMA and the 20 to be above the 50.
So they're fanned out, pointing up.
Exactly. They act as a visual guide to prove the momentum is pointing up, and they act as dynamic support levels. But the real trigger is the price action and the volume we discussed earlier.
Which brings us to what the text calls the post-imbalance setup.
Yes, the core setup.
Walk me through the exact sequence of events. Like, after we see that first massive institutional footprint, that giant green candle with huge volume appear on the 15-minute chart, what happens next?
After that big institutional candle and volume spike, you do absolutely nothing.
Nothing.
You wait.
Yeah.
You wait for the opposite side, which is usually the retail sellers, to react to that sudden jump in price.
We wait for the splashers to try and fight the wave.
And what you are looking for is a highly specific visual representation of weakness.
Okay, what does weakness look like?
You want to see the subsequent red candles become very small and the volume underneath them completely dry up.
Right, because when the price starts to pull back but then hovers right at that 10 EMA line, think about what's actually happening behind the scenes.
It's fascinating.
The retail traders are frantically selling, trying to take tiny profits or push the price down, but the price doesn't drop. Why? Because the institutions are sitting right there at that moving average, quietly buying up every single share the retail guys are selling.
They're just absorbing it.
Exactly. The big money is absorbing the panic like a sponge.
That is the perfect way to visualize it. That tight consolidation near the 10 EMA proves mathematically that the sellers are weak.
They just don't have the juice.
They simply do not have the capital or the conviction to push the price through that institutional support wall. And your entry is only confirmed when you see a breakout from that consolidation phase.
The trigger.
Right. You need another strong green candle accompanied by high volume pushing up. That is the definitive signal that the institutions have finished absorbing the selling pressure and are stepping back in to push the price higher.
The weak sellers are now trapped.
Exactly.
Here's where it gets really interesting because we actually have 14 historical charts of this exact stock, FCT, proving that this highly specific mechanical system works in the wild.
The historical proof is incredible.
I was analyzing the CSV data and the chart dates, and the real-world metrics are staggering. Look at the chart recorded on June 18th, 2024.
The volume anomaly on that particular Tuesday was immense.
And Vents doesn't even cover it. It hit an 87 core volume on that setup.
Just massive.
That is 870 million shares changing hands in a single session. And if you followed this exact strategy, spotting the giant footprint, waiting for the weak sellers to consolidate in the 10 EMA, and entering on the strong breakout, the trade hit the 1-to-4 risk-reward target flawlessly.
And you know, the setup captured later that year is even more extreme. Look at the data provided for November 29, 2024.
Oh, man, yeah.
A 10-core volume setup. But the run it went on post-breakout was explosive.
It hit a 1-to-9 risk-reward ratio.
1 to 9. Think about the math on that.
One single trade using that exact setup could wipe out 9 consecutive 1% losses.
Which underscores exactly why the stop-loss management outlined in the document is so rigorously mechanical.
Because you can't just hope it goes up.
Exactly. You aren't just buying the breakout and hoping it goes up forever. The strategy dictates a step-by-step process for managing the trade once you're safely in the market.
So you never turn a winner into a loser.
Precisely. To ensure you never turn a winning trade into a losing one.
According to the text, once your trade hits a 1-to-2 risk-reward, meaning you are currently up double what you initially risked, you immediately move your stop-loss to your cost basis, your break-even point.
Right.
At that exact moment, taking a loss on the trade becomes mathematically impossible. You have a free ride.
And from there, as the trade progresses to a 1-to-3 ratio, you trail that stop-loss up to lock in a 1-to-1 profit.
So no matter what happens, you are walking away with 1%.
Guaranteed. Finally, when it hits that magic 1-to-4 mark, you automatically book the full profit and exit.
You're out.
You're out. The charts, the EMAs, the volume spikes, They literally only exist to give you that highly calculated entry point.
Yeah.
After that, this mechanical stop-loss management takes over entirely. Emotion, hope, and fear are completely removed from the equation.
Okay, but if I'm listening to this right now, I might be thinking, this is fascinating, but I have a full-time job.
Right? I can't be a day trader.
Exactly. I cannot stare at a 15-minute chart all day waiting for perfectly formed low-volume pullback candles to bounce off an email line.
And the authors of the document actually account for that reality.
Oh, they do?
They do, by detailing how this exact same logic applies to much longer time frames, what they call the swing or positional strategy.
Okay.
You take the exact same core concepts of institutional imbalance, footprint identification, and weak sellers, and you apply them to weekly or monthly charts instead of 15-minute increments.
Does moving to a weekly or monthly view change the math, though? Like, is it less effective because things are moving slower?
The text actually notes that moving to a higher time frame puts the probabilities even more in the trader's favor.
Oh, really?
Yeah, because it filters out all the intraday noise, the algorithms fighting each other, and the daily volatility.
That makes sense.
However, for this positional approach, the technical tools do shift slightly to accommodate the longer horizon. The strategy suggests switching from standard candlesticks to Heikin-Ashi candles, alongside a supertrend indicator set at the tight parameters of 1-1.
Okay, let's break that down. Normal stock charts look incredibly jagged and chaotic, right? Like an erratic heartbeat.
Very erratic.
But if you switch to Heikin-Ashi candles for these longer views, it changes the visual entirely. Instead of just plotting exactly where the price opened and closed every day, Heikin-Ashi uses a mathematical average of the previous prices to paint the candle.
It's brilliant.
It literally smooths out the jagged edges. It hides all the daily panic and noise, so you only see the true underlying trend.
And that super trend indicator set at 11-1 acts as a highly sensitive visual trailing stop. Because you are holding a position for weeks or months, you need a mechanism that tells you exactly when the macro trend has definitively reversed, so you don't give back months of profit.
The big picture chart they provided for FBT on the monthly time frame is a perfect example of why zooming out matters.
Oh, that chart is telling.
You look at the period from December 2020 all the way to June 2022, and it's basically flat, dead water.
But then you see the macro shift. From November 2022 through February 2025, it enters this massive, undeniable uptrend.
It just takes off.
It does. And if you are trading on those higher time frames, you are looking for specific, undeniable signals within that macro trend. For instance, the document highlights a concept called buyer strength.
The text says you look for price action when it drops near a strong level, like that 10 or 20 EMA or a key historical support zone.
Right.
And if a red seller candle closes and the very next candle is a green buyer candle that opens with a similar low and rockets upward.
That specific two-candle formation shows intense urgency from the institutions.
How so?
It visually demonstrates that the absolute moment the retail sellers pushed the price down to that specific support level, an institutional algorithm was waiting there to buy everything available.
Ah, they just scooped it all up.
They instantly absorbed the selling, matched that low, and drove the price back up. It's a permanent footprint showing that buyers are significantly stronger than sellers at that exact price point.
Okay, we have covered a massive amount of ground here.
We really have.
15-minute charts, monthly swing trades, exponential moving averages, Heikin-Ashi smoothing, weak seller consolidation, and strict 1-to-4 risk ratios. But knowing the math intellectually is one thing.
Oh, absolutely.
Actually executing a trade when real money is on the line without your heart exploding out of your chest is another thing entirely. How does someone actually learn to do this automatically?
It all comes back to the psychology of practice.
Yeah.
The very last point in the source material emphasizes that rigorous practice is the absolute key to making this mechanical system work.
Just reps.
Reps. They strongly advocate for repeatedly practicing these exact patterns by deep diving into historical charts, studying hundreds of examples, just like the 14 charts provided for as secrete.
So you essentially stare at the past until the future looks boring and familiar.
Exactly the point. The text argues that consistency and pattern practice systematically remove fear.
Because you've seen it before.
When you have seen that exact same setup of weak sellers consolidating near the 10 EMA 1,000 times in historical data, when it finally appears in the live market, you don't freeze.
You don't pass.
You don't second-guess yourself. You execute confidently because you have rewired your brain to know the mathematical probability is on your side.
To bring all of this together, The entire strategy relies on identifying the imbalance created by massive institutional footprints, those giant volume spikes that retail traders simply cannot fake.
We follow the giants.
Right, we aren't predicting the market, we are following the giants. We wait patiently for the weak sellers to exhaust themselves near the 10 EMA, and we only enter on the strong, confirmed breakout. And most importantly, we completely abandon the myth of the high win rate.
The biggest takeaway.
We rely on strict 1-to-4 risk-reward ratios, systematically trailing our stop losses to protect our capital, ensuring that we mathematically survive our inevitable, frequent losses.
If we connect this to the bigger picture, it becomes remarkably clear that technical analysis, the charts, the candles, the EMAs, serves only one limited purpose.
What's that?
It exists solely to give you a highly calculated, high-probability entry point. The moment you're in the trade, the technical analysis ends, and cold, mechanical risk management takes over entirely.
So what does this all mean? We started this deep dive talking about the illusion of perfect precision, that desire for a crystal ball that never gets it wrong.
And we found the opposite.
And we discovered that the real blueprint for success in one of the most chaotic environments on Earth is entirely built around failing 70% of the time, safely. So I want to leave you with this to ponder. If trading for loss, strictly capping your downside at 1% while relentlessly demanding a 4x upside, is the mathematical secret to surviving the total chaos of the stock market? Wait, let me rephrase that. If doing that is the secret to surviving the market, how might applying a strict 1-to-4 risk-reward filter change the way you make decisions in your career, your business, or your daily life? Are you taking enough 1% risks to catch those massive waves?
It's a great question to ask yourself.
Thank you so much for joining us on this deep dive. Keep questioning the consensus, keep studying the footprints, and most importantly, keep learning. We'll catch you on the next one.